When I ask people what they do with $50,000 sitting in cash, almost everyone answered the same two ways. Leave it in savings or put it in the market. Almost nobody considers the option that banks have been quietly using for decades. I hear this every week. People treat their money like there are only two rooms in the house. The safe room and the risky room. And they just pick whichever one scares them less. Nobody's wrong for thinking that way. It's what we've been shown. Every ad, every bank app, every advisor conversation reinforces the same two lanes. But there's a third room. It is the room that the bank itself sits in. And it's been open to individual investors like you and me for a long time. Most people just never got a tour. So let's actually open that door. Mortgage note investing means owning the loan behind a piece of real estate instead of owning the property or gambling on a stock ticker. Here's how it actually works, start to finish. A homeowner has a mortgage. Somebody holds that loan, usually a bank, sometimes a private lender or institution. That note holder can sell the loan to someone else. When they do, the buyer steps into the exact same position. Same borrower, same payment, same collateral, same first lien on the property. That buyer can be you. The reason this works is structural, not clever. The real estate is the collateral. If the borrower is current, you collect on a contractual monthly payment. On a schedule that's already in writing for as long as you hold the note. If something goes wrong and the borrower stops paying, the property is still standing behind the loan. That's what first lien position means. You're not hoping the borrower pay. You're secured by an asset if they don't. That's fundamentally different from a savings account, where your return is whatever rate the bank feels like offering that quarter. And it's fundamentally different from the stock market, where your return depends on where the price happens to sit that day you need the money. None of this means note investing has no risk. It does. Borrowers can still fall behind, and working through that takes real process. Verifying payment history before you buy, understanding the loan to value ratio, knowing your legal position if a loan needs to be modified or worked out. This isn't a hands-off lottery ticket. It's underwriting. The same discipline a bank uses, just at your scale instead of theirs. That's the piece almost nobody considers when they're staring at $50,000 and picking between safe and risky. There's a third option, and it's not exotic. It's literally the oldest trick in banking, just made available to individual investors like you and me instead of only institutions. I'm Mario, co-founder of Original Notes, and if this is the first time that you're hearing about mortgage note investing, that's exactly why we built the free 5-day Become the Bank Challenge. 5 short videos, no pitch, no obligation, just the mechanics laid out clearly. If it resonates and you want to talk through your own situation, you can always book a call. 2 lanes isn't the whole map. Now you've seen the third door. What would you do differently with your own money now that you know it's there? Tell me below.